So
One
let
armed
me turn
bandit
that.
in a butt kicking contest.
Hmm. I'm
That's
not
deep.
sure what the butt kicking, how the one arm makes him more busy than someone with two arms.
But you know, man, it's a hunt, that's for sure. So it's been a good
That's funny.
day. I got about 50 calls for refinancing and stuff based on interest rates in the market today. So that's one of the,
What are interest
it's
rates right
been a
now?
good busy day. Yeah.
That's a perfect segue into our conversation
Okay.
tonight. What is
Okay.
interest rates
Good.
right now?
Good. 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 Yes. So obviously the Fed
Is he frozen for you?
Mm-hmm.
Okay.
Mm.
are we still there,
Lost him.
guys?
Oh, there we go. It
There
froze
we
up for a little
go.
bit.
You're back
Yep.
now.
Yep.
You
No worries.
froze.
No worries.
We didn't hear
Okay.
anything you said.
Yeah. So interest rates obviously are based on the 10-year treasury note. So the 10-year treasury note been hovering about 4.12 last I checked a little earlier today. It was at 4.20. So as it comes down, interest rates are affected by that for bonds. And so uh, they're saying if we break the 4.10, you might see some more activity. It's been good. So um, I locked a loan in today, 10% down, 700 plus credit scores, and uh, 6.375 with 10% down. So, and then I did an
Mm.
FHA loan. Obviously, it was like five and a quarter, but of course, you got mortgage insurance. So different. So, yeah. But yeah, so that's where rates are
If you
today.
put mortgage, if you put mortgage insurance in terms of a percentage, how much additional is mortgage insurance on top? Because I feel like that would make it easier to like understand the additional cost that you incur going through FHA. Because if you're talking about 6.375 and FHA is five and a quarter, which is 5.2, that's like a point and a half
Mhm.
less. I mean, not a
All right.
point and a
So
half, a percentage and a half less. But if
the,
mortgage insurance adds another percentage, then you're like, oh, well, you're only saving a fraction of a percentage, which again
yeah, yeah.
might be some.
Here's the difference between the two is that FHA insurance, the mortgage insurance is on for the life of the loan, no matter what.
Mm,
So conversely, whereas conventional, the rate might be higher, but the mortgage insurance uh, is on a monthly basis. FHA, there's an upfront fee of 1.75%. So whatever the loan amount is, you got to multiply that by 1.75. That's what the government charges as an upfront fee. And then there's a 0.55% monthly fee. So that's even the rate is five and a quarter, but they're basically baking in, you're paying an upfront fee to get it. And then on conventional financing, you could either pay the monthly mortgage insurance, and in this customer's case, we basically financed it, included. It was only like maybe a point fee to basically have it whereby it's now included his mortgage, and then that becomes tax deductible. But then, mentioned the new Trump laws came into effect for tax of 2025. The mortgage insurance is tax deductible. So anyway, that's just a little caveat.
mortgage insurance, period. So even on
Yeah.
FHA loans.
On FHA loan, well, yes, FHA and conventional, but they have a formula based on your income, based on how much you're paying in mortgage insurance for it to become tax deductible. But I was at a seminar like a month ago. They were talking about the new tax changes and mortgage insurance being included in it with it.
Mm,
So
that's
Helps a
interesting.
little.
yeah, a little bit, but yeah. And for me, mortgage insurance has been for FHA requires a low that the barrier to entry is lower. So as a result of it, um, folks are able to get it. But if you have a higher score, I'm not trying to encourage you to get FHA loan. I want you to get a conventional loan because a year or two, you'll be able to refinance and get that mortgage insurance. Or in 2 years, if the value goes up to 80% LTV, you don't need the mortgage insurance at all. You get it removed. So
So you're telling me I'm paying mortgage insurance that I shouldn't be paying? That's what you're telling me.
if you bought that house, James, 3 years ago, and you
I
had
did.
mortgage insurance at the time, and now
I
the
did.
value now is at 80% LTV. All you have to do is just contact your lender. They may or may not require that you have to get an appraisal. If they show the value is that, the mortgage insurance comes off immediately.
Oh man, I didn't make that phone call.
Make that call. I would highly encourage
I
it.
need to make
That was
that
worth
call.
this call right now. Yeah, right. Yeah. So
It's like, say what? Bring the
yeah,
mortgage cost down?
yes,
Make that
absolutely.
happen. I mean, I should have done it. Shoot. Anyways,
We actually went through that process with Wells Fargo.
Yes, yeah.
So
who do I need to
yeah,
call? My loan
Uh,
provider?
your existing loan provider, call them up today, customer service, and say, hey, listen, I want to have my mortgage, my PMI to be removed. And they may say, okay, we're going to do an internal check to see what the value is and make sure it's 80% loan to value from your balance now. So they may do it and say, okay, you're fine. We
So they're
checked it.
just gonna look at the okay, got it. So they're gonna look at the current value, at least like the estimate. And if
Yep.
it's like, again, let's say it's 500K, they're gonna take
Mhm.
80% of that, which is 400, and be like, if I'm under 400, they'd be like, off.
Facts. That's exactly how it works. Yeah. Worst
so let
case
me ask,
scenario,
I need to
they
make
may
that
make
phone
you
call
do the
ASAP.
appraisal. Yeah. Real talk. Go ahead, Brandon.
what is the mortgage insurance a profit center for the lender?
Great question. Think of mortgage insurance the same way automobile insurance. The insurance is not for your benefit, it's for the lender. If your car gets in an accident and something happens, it is for their benefit. Mortgage insurance on a home is that when you don't put down 20%, they deem that 20% threshold to be the kind of breaking point, so to speak. So lenders say anything over
Mm,
80% requires that you got to get mortgage insurance. And if you default on this mortgage, that gap will get that month insurance pays for that gap for us to be
that's
reimbursed.
crazy. So it's
Yeah.
gap insurance for the
It's gap
lender.
insurance. That's it. That's it. That's it. And they're basing that gap insurance on your credit, the loan to value, some other factors that come into place. When we price out mortgage insurance, they're going to go by the score, the LTV. If it's 2 bars versus 1 bar, they got a whole big old formula. They can come and says, okay, based on this, and of course the loan amount, the mortgage insurance is going to be $80 a month. And then when you get to 80%, that is removed. So the benefit absolutely is for the lender because they
Why
want to
don't
make
they?
sure that
Dude,
if
I
you
hate stuff
default.
like this. I feel like a just lender
Mhm.
would just have a policy that just removes it. It's almost like people who sign you up for subscriptions with the intention or with the anticipation that you will forget to cancel. So it's
Yeah.
just like, oh well,
Yeah.
the whole idea of mortgage insurance is gap insurance. It's gap insurance for the lender. So if you default before reaching that 20%, you
Mhm,
know,
mhm, mhm.
upfront
Yeah.
cost that we expected to collect, we're going to take out this insurance, make you pay for it. It should be like, well, that's not a subscription I signed up for. I just wanted the house.
Yeah.
But they're like, well, this just comes with it. That's just part of it. It's like,
Now,
I feel
James,
like
I
it should
will
be
tell
baked
you
in.
that
That like, hey, once you get to 20%, it just comes off.
at 5 years, it does automatically come off, but they're gonna get you for 5 years. So if you don't
At
say
5 years
anything,
of the
60 months. So if you've had it for 5 years, they will automatically move the mortgage insurance from it off. But if in 3 years the value is there and you didn't say anything, they're not gonna call you and tell you that you
free
need to
money.
do it. Yeah.
I'm so mad
So
right now.
yeah,
Notice all the
that's
stuff.
definitely on you as the consumer, the owner of the home. Yeah. So
I feel like one of these days, if we keep doing this pretty actively, I'm gonna get like some sound effects. It's gonna go, yeah, right across the top.
right, exactly, exactly. Yeah,
Like, yeah,
yeah,
hey, tell me. Free
Okay, I want
money.
to pick
I
up
don't need no
pick
more
up
free
where we
money from
left off
nobody.
last week.
Okay, Brandon, say it again.
I want to pick up where we left off last week.
Okay, let's do it.
So last week we were talking about the countdown method. Um, we had kind of gotten through the first, the
Hmm.
4, the 3, the 2 potentially. Um, we had talked about either going to a different part of town or having a larger unit
Hmm.
next to the yard. The family's growing.
Yeah.
Um, So assuming we
Yeah.
get from 4 to 3 to 2, going from
Hmm.
2 to 1 seems like it could technically be in the same neighborhood because there's a there's a stark difference between a duplex and a single family,
Hmm.
and you can easily, argue why you want to move from, a duplex to a single family. Would that be
Yes.
accurate?
Yes, i.e., so one of them is going to be that if I had a duplex, and let's say it's a 2,200 square foot duplex because each one is 1,100 square foot each,
Hmm.
and it could be the location, it could be the other tenant that I have next door, blah 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 blah. So I'm going to move to a single family, bigger home, and it's going to be my owner occupied residence, and it could be 5 miles away. You can, and if it's a bigger home and a better school district, i.e., just some other factors, you probably can get away with that with no problem. That this is what you're doing, and then they'll take it and you can rent the other unit out. Yeah, I'd say based on some of the previous scenarios that I've had in the past, yeah, you can do that. Side note: during COVID, they allowed you to work and live anywhere in the country remotely, and it'd be your primary residence. So I had a young lady that was if I'm not mistaken, she was in Washington, D.C., and she bought a home matter of fact, she bought a multifamily in Houston, Texas. Even though
Mm.
she worked somewhere else, she was allowed to say it was her primary residence because everybody could work remotely. That's how she pulled that off. And I don't know if she left DC or not, but the premise was that this is
Besides the
my
point.
primary residence.
Hmm.
Yeah, yeah. So, but
See,
that doesn't.
Wow.
see, I feel like when these things happen, you
Yeah,
need to be on a bullhorn telling people, listen, it
yeah,
don't matter
yeah.
where you live right now. You got
Right.
3.5. If you can come up with 3.5, 5%, you could buy some in out
And
Yo.
in
I
Arkansas.
remember the young lady because she worked for a bank, but she was also a part-time realtor. So she was absolutely looking. So she had found the place and the whole 9 yards. She was taking advantage of that. But again, of course, man, that was a year, 18-month window. So
Mhm.
went from COVID
Mm.
from 2020 to 2021, 22, second home financing, the rates were so low with 10% down. That's why we did so much second home financing. And they changed the pricing grid because Fannie Mae and Freddie Mac changed because people were buying so many second homes. Because the rates were almost as good as a primary residence at the time. They're buying them at the beach, the mountains, and making them investment properties later on. But you're buying them as a second home, so you got almost owner occupied rates with just putting 10% down.
Mhm.
So that window. But I will blow my horn about this right now. Last week, James, I did a construction and renovation seminar for about 35 realtors. I had a couple of general contractors on the panel with me and a real estate appraiser. Uh, I think that investment, purchase, renovation is one of the best kept secrets today. So if you wanted to buy an
Say that.
investment
Say that
property,
again.
investment, purchase, renovation. So if the
Okay.
house needs work on it, you got a good deal on it. You can purchase it and get the money to do the renovation up to 80% financing on an investment today. So if it's
So
in
10% down.
LA, high cost area, uh, if it's in any other area, like if it's in Arizona, Charlotte, Phoenix, then you can buy house is 150 grand. It needs 50 grand, but it might be worth 400. You can purchase it and renovate it up to 80%.
It's worth 400 after renovation.
Yeah, that's say you got a good deal in a market. It's you're in a great neighborhood and you got a good buy on it. 150, you need 50 grand of renovation on it, but they're selling for 400 in the neighborhood or three. Or three. That's a purchase renovation. I had a guy here in Charlotte in 2019. He did four of them. So that's what we call a fix and flip. He got him a line of
Hmm.
credit on his primary residence. He got a general contractor. He had a realtor, and he would close on a home. And he was buying in a neighborhood that was transitioning. So he might be getting for 125,000, spend 50 grand, and put them on the market for 250. And As soon as he closed, his agent put a sign up saying "Coming soon," and they would do the work. And so the people come by and it's coming, and they renovated the house. Some people that wanted to buy it, he says, "Hey, I haven't put flooring down yet. Whatever you want, we're glad to do it for you," type of thing. And he sold those places. He probably made about 50, 60 grand a clip on average, but he did it 4 times in the course of a year. That was impressive.
Yeah.
So anyway, so that's what I'm seeing. And what I'm doing right now today is I'm doing home equity lines of credit on investment and owner occupied properties, and people are buying DSCR. They're buying investment property with those proceeds.
With the HELOC money.
Prime plus maybe a point. So if you're 6 3/4,
but you're saying they're buying investment properties by taking the HELOC on their current homes.
On the current homes and their investment properties. That's nothing too. We're doing lines of credit on investment properties. And so that's been a really big thing for me last year and this year as well. Got a couple of clients that own and rental properties free and clear. I give them a line of credit, man, up to 80% on a single family residence. The guy took the 200 grand. I had one client, he took 200 grand and got a construction loan on another property. Brandon, he tore it down and built 2 other houses on it. He had some funds already. He had some loan financing, but he got a construction loan to build 2 units that he's going to sell, and he used that 200 grand in cash from his line of credit to kind of bridge him over while he got it done. Slick.
I feel like this is
yeah.
If I were to sort of relate this to a college curriculum, I would say what you're talking about right now feels like, 300 level, 400 level courses. It's like, hey,
Gotcha.
for my entering freshmen, for my freshman class, y'all stay away from this
Right.
until you done did a couple of internships, until you done apprenticed a couple times. Stay away from the HELOCs on the primary residences.
Right.
And hey,
real
Brandon,
talk.
shout out on the Quanu sweater, real quick.
That's what's up.
But yeah. I think we'll definitely get there. I think that's definitely coming. Brandon, you were talking about the countdown method stuff. I missed the question. Did you go from 4 to 3 or 3 to 2?
We were talking about going from 2 to 1 because we got to 2 last week. So we're talking about going from 2 to 1, and the main question is the lender and the lender's underwriting team going to buy in on this story because they're going to see all the other assets, properties that you have. So my whole goal is to make this plan somewhat, like, I don't want to use the term foolproof, but just hiccup proof, right? Like we can't we think of all the go ahead.
Now I was going to say to you, as I think about it, so let's use Phoenix for the sake of conversation, that you've got 3 properties and they are scattered between is it a West Phoenix? No, West Phoenix, Glendale, Chandler, and what's the other one? Scottsdale, right? Okay, yeah. So that perimeter, right? So the first place, remember now, let's say the first unit was a 4 unit. You're going to have 6 months in reserves. So that's the other asset piece of it. Your down payment's only 3.5, but you're going to have some reserves. So they will tell you today on the first one, you need, if I'm not mistaken, FHA requires 4 months in reserves. Fannie Mae is going to require 6 months in reserve. You can use a retirement account, a 401k, to act as reserves, but you're going to need 6 months of reserves of the payment. So just remember that. So you pulled off the first one, the first 4, and then you moved to the next town over, and you bought a 3 unit. You're going to need 6 months reserve for the 4 unit and for the 3 unit. So just remember that it keeps compounding as you keep going, but hopefully you would have got some appreciation and some equity growth type of thing to be able to kind of do that. But just remember that, and depending on your price point, you might already have the cash to do it. So you 4 unit, 3 unit, and then you went to the next town over and you bought a duplex. You pulled it off. So distance So one of the things, right, you look at is distance. Keep that in mind, and then assets, obviously, and then square footage. How big are units? So let's say the 4 units are all 1,000 square feet each. No big deal. No, so that's all right. You lived in one, you got the other three out. Let's say the duplex might be what? Brandon, you built one that might be 5,000 square feet, right? So they may be that way. Now, if I'm going to go from this size to the next one, uh, from that 3 unit to that 2 unit, they're going to be looking at proximity and they're going to be looking at motivation. Why am I leaving this house to this house here in San Francisco, my primary residence? Now you're going to have some reasoning for it, i.e., school district, growing family, more space, in-laws moving in, et cetera, et cetera. So we have to be, it's generational living today I'm going to be doing. So those things should probably factors to keep in mind that I need to
But
take
you were
these.
saying that, but you were saying that like a solid motivation. Again, I think I brought up
Mhm.
my situation now that we're bursting at the seams.
Yeah.
Like we need to find something bigger, and because we need to find something bigger, and currently, if I were to take my front house and the back house, I'm technically in a 2.
Okay.
So like if we bought something else, I could still qualify for an FHA. I need to get out of the FHA I'm in now, right, and refi
Provide
into a
as long as it's not an FHA. Exactly. Yes. Yeah.
yeah.
So
So
to Brandon's
if
point
I
earlier, you would have to refinance it out of the FHA to conventional, and then you can use FHA again. Yes.
So
Brandon, what's the question?
when we refi from the FHA to conventional, can we pull a little bit of extra dough out for the reserves?
Great point. If there's equity in it, the answer is yes.
How
Absolutely.
much? So let's
80%.
just
Whatever we need.
let's workshop this. So
Mm-hmm.
let's say I
That's
bought
why we need
mine.
the whiteboard, by the way, because I can just be,
This is true.
but go ahead.
Mhm.
So I purchased for 3 something.
Mhm.
I think right now it says it's like close to 480, something like that.
Okay.
So that's why I'm like property mortgage out. Just like I have, so I'll make that call as soon as possible.
Yeah. And so
But then
here's
you're
the
saying
thing.
I could
If you're gonna get the MI removed, but if you're gonna refinance it to get your some cash out, do all of that at one time.
Mhm.
And then at that point, you can go up to 80% cash out. So you go to 80%, take whatever that cash out, and that's your reserves. And then
80% of the equity cash out.
someone asked me that earlier. So think equity is in value. So it's
Yes.
not to so whatever the value is, I can go up to 80% minus the first mortgage that's on it now. So let's say it's worth
Say that
480,
again.
500 for sake of conversation. Worth 500, 80% is going to put you at
Four.
that number. Was it 420? So 420 minus the 360 that you owe on it. That's the difference in cash that you can have. And you can
Okay.
take that
The new
cash.
loan is going to pay off your existing loan, right?
Mhm. Yep.
So, but the new loan could be more than your existing loan.
Yep.
So
Up to
first you have to
80%.
satisfy the existing loan, and
Mhm.
then whatever's left over from that would be cash, would be
Yep.
what they call cash out refi.
Exactly. Yep.
Right.
Absolutely.
But I would have a new loan at a new rate at a new payment
Agreed.
that I'm
All of that's
responsible
new.
for.
Yep.
Yes.
Yep.
But yeah, all of that would be new, and the assumption would be that new note would be sort of against, or at least the new renters would be paying rent against that new note, and then I
Yeah.
would use cash out to go get something else.
Exactly. And you
Is that
want to
the
do
idea?
it first before you buy the new place, because then it's not owner occupied. Then it's investment, and the pricing is going to be
Yeah.
different. So whatever thou doest thou quickly here first, type of thing. Yeah. So
Time is of the essence.
time is of the essence. Absolutely. So you do that,
But
and
you're
then
saying
now
I could go to a 3.
Mhm.
That was the question last time. I can go from a 2 to a
To a
3, and then from a 3
Yeah.
back to a 2, then to a 1.
Mhm.
So mine
Yep.
would be
First
like a
move is the
2.
easiest because the first move, you have a lot more options of what that motivation is, right?
A good point.
Mhm.
You've got geography,
Mhm.
you've got
Family
in-law,
size. Yeah,
right?
yeah.
Family size. Um, you've got square footage.
Mhm.
You've got you've got all those things and maybe a few more that you can use on the first move, right? The first
Mhm.
move from 4 to 3, or from whatever it is, from where you are to the next one. But
Agreed.
that next one is where everything gets more scrutinized, because now it's clear that you're an investor.
A
So
pattern is developed, right?
there
Yeah,
you go.
yeah.
Mhm. It's starting to look like a duck and quack like a duck, right?
Right, right. It's starting to look just a wee bit, right? Yeah, yeah. And underwriter will get the file, look and says, "Let me now. He live where? What? Now, if it's been some time in between it, but she says, okay, he lived here for 2 years. He lived here for 2 years. Lived here for 2 years. Uh, and so then they would probably go back and look at the houses that he previously lived in and the square footage and the purchase price. And so then,
Mm.
yes,
Okay. So are you telling me that there is a person that gets to decide if I could do this or not? Just one person that's in his home office somewhere.
yeah.
Is that what
Uh,
you're telling
I'm
me?
no, no, not 100%. However, it's uh, so it goes through an audit. So Fannie Mae and Freddie Mac has desktop underwriting. The whole idea was to prevent bias, right? Especially from racial lines, right? So if the loan comes back and say approved, eligible, I tell folks all the time. So they run it through the system on the face of it. So again, the originator says, okay, I got this guy, this loan application. He's buying this place. And I've already checked it. They're not FHA loans. He wants to buy an FHA loan now. His he's got a 3 unit, he's got a 2 unit, and he's looking to buy another 3 unit. And how far apart? So now I got to do my homework because it's going to be how it looks. I tell folks it's got to be plain and obvious on the face of it. If they have to interpret what anything means, they will rarely interpret it in our favor. So
Mm-hmm.
it's in the presentation. So if I have everything presented well, and also too, and sometimes you give a motivation letter up front. So I'll say, hey, this loan's been approved. Here's a purchase contract. And if there's a question about the fact that they're only 10 miles apart, I will explain that. I will
Okay.
say, I'm going to get in front of it and say, hey, listen, this my client's buying this house. His previous house is 10 miles away. He's buying this new place. He's already rented it out, see the lease agreement, but he's buying this new place because it is in the more desirable school district. He's got school age children. The application reflects he's got school age children. And he
Mm.
says, my in-laws are going to be retiring, moving from Florida, they're going to be moving in with us. So he needs bigger space. And matter of fact, he's buying a 3 unit. He can justify that his in-laws going to be staying next door, and he's going to be living in the other unit. And it just happened to be a 3,000. It's an old colonial building. It's in Larchmont. It's in Hancock Park, Brandon. And they got those big duplexes and triplexes where it
Mm-hmm.
might be 6,000 square feet, and it's a duplex. Now that 3,000 square foot unit it's not strange or odd.
Hmm.
Okay. This is why this is why borrowers need to work with people who are forward thinking, people who care about their clients, and they're not just a number, and also people that just literally know what they're doing. So
Agree.
can you take this time to just let people know, how do they
Yeah.
find you?
Stanley Wade, North Point Bank. My cell phone number, you can reach me, is 626 area code 234-3653. My email address is my website, www.northpoint. North Point has an E on the end of it, northpoint.com/Stanley-Wade. And you can find me as the richest man on earth one on IG, and Stanley Wade on Facebook. So,
Sweet.
yeah,
Thank you.
you're
You're
welcome,
putting all
man.
your information out there on the interwebs. It's out there. This is
Yeah,
alive.
real talk, man. Absolutely. Yeah.
Saying like I'm doing these
James, did you have a
deals. Come
question?
at
It
me.
looked like you had a question before I jumped in with that plug. No?
No, I think I
Okay.
was saying like I'm just thinking about our situation, um, and as we're in talks about what the next phase looks like, yeah, I'm like, oh well, if I can go to, and we talked about in-laws, like having space for
Hmm.
my wife's mom, so that her living expenses could be more stabilized, as
Hmm.
opposed to just getting rent out on the market and it's constantly being raised. And if she's on a fixed income, you know, there's not this stress of
Yeah.
I need to go work, I need to go do this, and she could be
Hmm.
close to grandkids. And
Yes.
it's just like,
Yes.
oh, this is just what rent's gonna be. Like,
Hmm.
Brandon, what's
I
up?
got a question for your scenario. So
Yeah.
let's talk about debt to income. So
Hmm.
if he's going to refi his FHA, pull a little
Hmm.
cash out for reserves and down
Hmm.
payment for a triplex, then his mother-in-law is going to be moving either in his unit if it's large enough or
Hmm.
in the unit
Hmm.
next door,
Yeah.
right? But his expenses show that he's paying X amount for daycare. Can that fall off because now his daycare is now moving in next door, as in, i.e., his mother-in-law?
Okay. Good point. So daycare is not counted in the overall debt ratio.
Yeah,
Okay.
that's just
So,
an expense.
but it's an
That's
expense.
just like
So,
actual loan payments that you're required to pay. Like someone has
yeah.
contractual
So those
obligation to
for
your
debt
money.
rate, yeah, good point. So you're only looking at especially stuff that's on the credit report, i.e., mortgages, car payments, student loans, credit card debt, those things there. Now, where he could benefit is that, well, if he didn't have a tenant, now his mother-in-law moving in with him, he gets to count that income in the
Mhm.
other unit. If it's a multi-unit, you get to count 75% of that income from a qualifying standpoint.
Mm.
So that might work, in your favor in that regard. But you can't take
Would I be?
75%.
I could take 75% of someone paying rent. Does that include the other property? So all of the.
Let's say let's say
Okay.
you're 2 unit now today. You're leaving the 2 unit and you're going to rent them both out. You can take 75% of the total rents and use them as
Yeah, that's
qualifying income for your new purchase.
Gross.
right. But I was still. I
Gross.
mean, gross. But I mean, I technically have another mortgage because those rents are working against the first mortgage, and then
Yeah, yeah.
if I get an
Oh, oh,
additional tenant, if this is a 3 unit, then those two ones would be. I understand. I see what you're saying.
yeah. So your previous place, you have it fully rented out,
Hmm.
75% you can use. Your new purchase, if it's a
Hmm.
3 unit, and you have tenants in 2 units and you're gonna live in one, you can use 75% of that as well too.
Of
Mhm.
each tenant,
Of each
or
tenant.
like
Yep.
of total rents. Total rents.
Total rent. Yep.
And the reason why the concept behind it is because the debt goes into the debt to income portion of the ratio. So then the income also has to go into the income part of the debt
Yeah.
to
Hmm.
income ratio.
Hmm.
So
Hmm.
that's why
Yep.
they take both of those.
Yep.
Yeah. Yes.
And they're essentially giving you a 25% expense ratio, saying we'll give you
They're
credit
they're
for
taking they're
75.
taking the 25% vacancy factor. That's why they're not giving you 100%. They're
Oh,
taking a 25% vacancy factor that at some point in time it may be vacant for a period of time. They're making an assumption because that is probably the averages, and as a
mhm.
result, you get to use 75%.
Got it. Okay. Okay.
Mm,
Thank you for
Yeah,
clarifying.
that's the method to the madness. Yeah,
Okay.
that's good.
yeah.
So
That's
right
good.
now, essentially, you could get into a triplex with potentially no money down because you could pull. I mean, you got to put
Oh,
money
if I
down,
take out if I take
but you
cash
could pull
out.
some
Yeah,
cash
yeah.
out, and then it goes into your new property. And as long as you're still covering the debt on current property,
Hmm.
I mean, you just turn 2 units into 5.
Now, I was going to say something in terms as to, let's say, the refi stage. If you like the rate you got on your loan now and you want to get rid of mortgage insurance, you would take some cash out, then don't refi the first. Just take a home equity credit line. If you got the 80% equity in it, if you got equity room in it and the first mortgage is good, and that's I got one right now as I was riding home. Uh, he is at 2.95%. I did his loan in 2021. He wants 50 grand to do some improvements on the home. I said, we won't refi you first, man. We just get your line of credit. He might be 7.25, depending on his credit score, and he's good to go. So keep that what you have there, and And yeah, we just
You
do
know,
it the
you're
other
not the
way.
first person who
But what
you're not
about
the
the
first person who
FHA
told me
piece
that.
though?
Yeah, if it's FHA, I'd say get out of it. But if it's not FHA, in his case, his is not an FHA loan; it's a conventional loan. And
Okay.
he
Yeah,
put
but I mean, at that point, you'd be saying, it's FHA 5.25 versus it's 5.25 plus mortgage insurance versus just
So
what
we're
might
talking about
be
what you have
6.
now.
yeah.
What do you have
What
now?
I have right now is FHA.
FHA.
Okay. So
Yeah.
so you're going to get rid of. We want if your loan is FHA now, then keep in mind
Mhm.
you can't call them and tell them to remove the mortgage insurance because FHA is on for the life of the loan, whether you had 20% equity or 80%. So the only way you're going to get rid of your mortgage insurance is refi that loan.
I see.
Because the FHA loan, you can't get rid of the MI. It stays on for the life of the loan.
Mm, okay.
Yeah. And besides, if you want to make a new purchase, multifamily FHA, you want to get rid of this current FHA loan anyway.
Yeah, but you're saying the home equity could do that.
No,
Well,
not in your case.
exactly, not in your case. If you had a conventional loan, yes.
I
But
see.
with it,
I see.
if it's since it's FHA, I'm gonna say refinance it into a conventional loan, do a cash out, take that cash, you got what you
Take the
need, and
cash.
then get ready to make your move with your new purchase.
Got you. Got you.
Yeah.
Got you.
That's it. That will be the strategy that I would look for you. If your intention is
Like
to get
that's
you
the move.
something else and you want to put down
Yeah.
3.5% on a new one, get rid of this FHA so you can get a new FHA.
So
Yeah.
Heard.
a lot of your work, Mr. Wade, seems like consulting borrowers and families on what's out there, what's available, what you guys offer, and then also using your wisdom and knowledge to give them what you feel their, top two scenarios are, right?
Yeah. Quite honestly, man, I'm a mortgage advisor. I tell folks I'm gonna give you some mortgage advice for your life in particular, because no two situations are alike. Young lady comes in, she's got a 780 credit score, she make $200,000 a year, she's buying a house. Easy. She got 5, 10, 15, 20% put down. Couple comes in with a 640 FICO score. FHA is going to be the route for them to lower their payment 3.5% down because they're just got enough to get in it. So again, each individual situation, but yeah, I get the privilege of doing that. Man, I do a lot of construction financing. I have clients, man, that are high net worth individuals making excess of $1 million a year, buying, $2, $3 million cribs. It's a different beast. We have a different conversation about a different product for them because they tend to be second and third time move up buyers, and they're pretty savvy, got a good understanding about it,
Mhm.
and some of them become more easier to work with because he knows how this works. They just send me the stuff I need, and we just do what we need to do. But they're more conscious of rate. Um, and get me the lowest possible rate. I've got a client right now that's looking to build a $3 million house, and he wants an 18-month construction loan. We only do 12 months, so got to see if I can get him an exception to be able to, because he's building a 6,000 square foot house. It's going to take some time, and he's got a lot of finishes, et cetera, et cetera. So different.
Yeah.
That is a gas guzzler, but he probably ain't worried about it.
Yeah, it's all relative, right? It's all
Yeah, yeah,
relative.
yeah.
Yeah.
Yeah, yeah, yeah.
But no, I everything from home equity financing to first time home buyers to move up buyers to dream homes to construction financing to like investment. I get to do all kind. I see all walks of life on a daily basis. So yeah, my job is to solve problems, and so I get to solve some problems. So
Hmm. Very
What
cool.
if you could say we got a few minutes left. Is
yeah.
there something in your work that is giving you some pain in any way? Anything in the market, the industry, anything that you could think of that you're like, man, I wish that would change.
Um, at the end of the day, well, student loans is always being heartburn. I ain't gonna lie. They're gonna always be right now they're heartburn because you have to count 50% of the payment, whether you are making any payments or not. And sometimes it throws people out of qualify. Uh, I'll leave you with this. I was at a commercial seminar a few years ago with a professor. It was a thing done at UNC Charlotte in the MBA program, and he talked about that we'll need shelter for the rest of our life. So you're gonna need shelter whether you own a home or you rent, but you're gonna need shelter. And he is saying he was making the argument that interest rates should actually be cheaper for people with lower credit. He said
Mhm.
because people with higher credit scores can afford to pay a higher rate. But he says
Would be
we
the same idea
tax.
as like paying taxes. Almost. Yeah.
Say it again.
It's almost the idea of like that would be a way
Yeah,
that
yeah,
high net worth people pay taxes is pay higher
yes.
interest rates.
Yeah, yeah, exactly. So he was just making an argument so that and I say it out to say just in terms of qualifying people that
Mhm.
man, I do some loans that we using bubble gum, we do everything, man, to get them to qualify for 3.5% down. And this is another reason why builders are offering big, large incentives to help folks buy the interest rate down because homeownership is still and unfortunately, that whole thing is getting further away. But homeownership is the single largest wealth generator, right, that we know of today. Homeownership, but that the idea of the American dream is kind of based like I'm going to have to help Nicholas buy a house today unless he wins a lottery or something. My son, but him buying a home today, he's going to need some assistance um, because I bought my first house at 22 years old. It was $125,000.
Mm.
Yeah, you can buy a house for 125, but you're gonna have to live in a you're gonna be an hours and change away from your job. So then that money you spend on gas and commute, it's defeating the purpose type of thing. So uh, yeah, so but that's what I say: student loans and just overall affordability and house prices today and income for a younger generation is just a little bit more challenging because oh, by the way, Brandon, I'm gonna send it to you. Study came out that the average age of the homeowner right now is 59 years old, not
Wow.
30. 59 is the average age according to the National Association of Realtors.
Oh no.
Yeah,
That's crazy.
that's
Oh,
crazy.
that's bad.
Yeah, yeah, because the younger generation is like, I can't afford a home, so they want to rent, or I'm gonna live with my parents.
Mm.
So,
And I mean,
um,
there's a lot on there's a lot on YouTube. A lot of finance people on YouTube saying don't buy right now. It's
yeah,
not a good investment.
I don't know if I
Which
agree with that
I mean,
scenario.
it seems like feels like recency bias, where it's just like in
Yeah,
like right now it feels that way
yeah,
versus again the control you have, the options you have, the
hmm
wealth that can
hmm
actually be generated from
yeah,
that,
yeah.
dexterity, what you can pass down, it being a hard asset versus like all this digital stuff and AI
Yeah,
that
yeah,
everybody
and
seems to be like so
tax
distracted
tax
by.
tax deductibility with depreciation at the same time. So I'm
Taxes,
still a proponent
depreciation,
of
yeah,
home
all that.
ownership. Yes, absolutely. Yeah. So
Mm.
that's my 2 cents. Um, guys, I'm gonna have to jump.
Yo,
Um, yeah, but man, thank you guys. I enjoyed this. Seriously, Brandon, James, let's keep doing this. I enjoyed this conversation, man. We can talk about any kind of segments about the marketplace and real estate financing today. I enjoy it. So thank you guys.
appreciate
I
you
like
as
it.
well.
You're welcome. My
See y'all
pleasure.
soon.
Okay, we talk soon. Thank you guys. I appreciate
Yes,
it.
sir.
All right,
Bye.
later.
Yep.
Oh, I thought you were gonna close it.